Plato and the fall of Greece, he was 9 years old when that happened, so he still remembers it.
I was on the steps. I was on the steps when Plato was there. That old curmudgeon. Oh man, 2022 has been a kick in the pants. Stock market down, crypto down, real estate starting to falter, war, inflation, high gas prices. It's ridiculous. In times like this, when it gets scary, Frank and I like to go to the sages in Omaha for their wisdom. Berkshire Hathaway just recently had their annual meeting. There were some incredible soundbites that came from Warren Buffett and Charlie Munger. We also looked at a few of their historical comments in this episode, where we listened to some things that the two sages said that always calm us down, and then we share our own perspective in our businesses and what's going on with our investments today. Hope you enjoy this one.
You're listening to Let Me Speak to a Manager with Frank Cava and Ian Matthews.
What a crock of shit.
Yeah, that was hot mic, Sam.
You can't say God on the air.
Don't worry, nobody's listening anyway.
Do it live. I'll write it and we'll do it live.
Frankie.
Ian, you son of a bitch.
Frankie, this time of year is special to us. It is right around when Warren Buffett and Charlie Munger come out of their cave, their exile for the year, where they sit around and read annual reports for 355 days of the year. And they come out and get on a stage at the Berkshire Hathaway meeting and wax for 6 hours. And it is always so fascinating.
And Ian loves it because Charlie Munger is 98 and Warren Buffett is 91. And the two of them both have more hair than him. And he really likes being with old people with hair.
Absolutely. I also like the fact that those guys have worked forever and they still are just curmudgeons and make fun of each other on a regular basis. It makes me think that one day you and I will still be doing this podcast when we're 91 and 98. Frank is a lot older than I am.
Correct.
So
the other piece of this, a couple of weeks ago, I was walking around with my wife and I was just in a really bad mood. I don't remember why. I was just like being kind of miserable. And she goes to me, "You're going to be awful when you're older. Like, what do you think you'll be like?" I'm like, worse. worse. Every year it gets a little worse. Things are more sore. The things that bother you that float around in your head just get a little worse every year. You're a little farther from your prime. It's that's totally true. You will definitely be grumpy when you're older. So there's no doubt about it.
We thought about going to this meeting, and just for whatever reason, Frank and I didn't pull the string this year. I think we're going to go next year. We went a couple of years ago and it was an awesome experience. We've talked about this before. And I think next year, definitely we got to do it. If these two are still kicking and alive next year, we're going to pull the string in that $1,000 flight and $700 for a days in at Omaha. I think we'll do it next year because I got to tell you, Charlie and Warren brought the thunder. They didn't lose a step from when we saw them 3 years ago.
Nope, they look similar, and the good news is they've added more peanut brittle to the stage.
Still crushing peanut brittle, still chugging cherry cokes. It's just fascinating. Longevity of those boys. I do believe the world is less fascinated by these two humans than us. So I think we should just get to the point. We're going to look at 7 clips today of things they said that we thought were interesting and we think have parallels. Last night, I actually had an invite to go to the annual meeting for a company called the Markel Corporation. Markel Corporation is structured very similarly to Berkshire Hathaway. Berkshire Hathaway is mostly an insurance company, and they use their float, which is the money that they collect before they have to pay out a settlement, and they use it to invest. That's what Berkshire does very well. What the company that I went to last night, what they do is the exact same thing, and they buy Richmond-centric businesses
because they're a Richmond-based company, but it's very similar. But what was really fascinating about it is I was sitting next to somebody who works in risk and casualty for Markel, which is one of their insurance divisions. And she runs the division, very smart. And she asked me, she's like, why do you pay attention to the Berkshire annual meeting? And like, why do you do it? I was like, well, I read the Apple annual review. I read the Google annual review. I've been doing these things for years because I think it makes me smarter. And not only do I think it makes me smarter, it makes me kind of connect the dots. I started reading the Wall Street Journal when I was in my 20s, and I would always ask myself, like, where the hell is the sports page? But what you realize when you read the journal or these things year over year is that life starts to have like a sequence of events that you can kind of connect the dots. And she asked it in a way that was kind of like a way that my wife would ask a question, and I almost get irritated the way it was asked. Then she's like, I spend 2 hours a day reading. And I was like, what do you read? And she reads like annual reports, and she reads things about other businesses. So like we mostly talk about business and career. But the reason we're going to talk about this today, and we think it's relevant, is here's 7 bullet points about where the economy is today, based upon 2 really smart people. And we're going to take it down to 2 very much less smart people who, how does this synthesize and make it into our businesses? Ian works and is selling car alarms, and he does coaching, and I do real estate. So these things permeate from top down. And I thought yesterday's conversation was interesting.
So, just in general, the boys are nervous. Warren and Charlie are very nervous. It's as negative as I've seen Charlie Munger in a meeting in a very long time, probably back to before the real estate bubble. He is incredibly nervous. Now, in general, these 2 are incredibly conservative guys. That's how they've been as successful as they do. They wait until everyone panics and the market burns for them to start buying. So in general, these guys aren't the rah, everyone run out and buy all the time. They're very patient. They build up lots of cash. But in general, and we're going to get into this first clip, the boys are incredibly nervous. And specifically, Charlie is incredibly nervous with the way the United States has handled our Fed policy and printing of money. So this is a clip of him talking a little bit about what we've gotten ourselves into.
When you print money on the scale that modern nations are printing it, Japan, the United States, Europe, etc., we're getting into new territory in terms of size. There's never been anything quite like what we're doing now, and we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so. When Volcker, after the 70s, took the prime rate to 20% and the government was paying 15% on its government bonds, that was a horrible recession. Lasted a long time, caused a lot of agony. And I certainly hope we're not going there again. I think the conditions that allowed Volcker to do that without an interference from the politicians were very unusual. And I think in 2020 hindsight, it was a good thing that he did it. I would not predict that our modern politicians will be as willing to permit a new Volcker to get that tough with the economy and bring on that kind of a recession. So I think the new troubles are likely to be different from the old troubles. You may wish you had a Volcker-style recession instead of what you're going to get. The troubles that come to us could be worse than what Volcker was dealing with and harder to fix.
It's fascinating. In part of it, you can hear that Charlie is terrified of what we've done. He's comparing us to Latin America, not good, hyperinflation, people rioting, governments overthrown. He's talking about Plato and the fall of Rome. He is saying that the odds of us pulling off what Volcker pulled off are not very good in today's political climate, and that we could end up wishing for a Volcker recession. And, anyone that was around in the early 80s, you and I were just kids, but our parents would tell you that was a brutal economy, late 70s, early 80s. And it was a long period of just kind of nothing. Stagflation was brutal on people. My dad lost his job. I'm sure your dad was struggling to find work. It was tough, and their costs were going up at the same time. So on one side, he can be so negative. On the other side, he's like, what the hell can you do about it? Over time, you buy when it's low and you try to find your opportunities. So it's really, both of these guys are really good at this, of kind of warning you, but also saying you can't do anything about it other than sticking to it and being resilient as an investor. I always find that fascinating, that they never leave any soundbite completely negative. They always talk about, like he comes back to Costco. Costco might be overpriced now, but over 30 years, I love it at this price. So I'm going to still own it. And he just kind of settles back in. It's always fascinating to me.
So there was a couple of things. When he mentions Plato and the fall of Greece, he was 9 years old when that happened. So he still remembers it. He did.
I was on the steps. I was on the steps when Plato was there. That old curmudgeon.
So that's number one. But he has a couple quotes in here that I think are great. One of them is, I want to swim as well as I can against the tides. I am not trying to predict the tides. To Ian's point a second ago about Costco, what they do is they buy low. Now, he talks about Volcker. He talks about the 80s. If you watch this entire video, and it's long, he talks about huge problems that arise with massive inflation. Massive inflation is your populace not being able to afford to live. So people do irrational shit when you can't live, or they're afraid they can't afford to live. I can't afford to feed my family. We are not farmers anymore. We go to grocery stores. So 100 years ago, Germany was an advanced society, a very advanced society. The populace did not think that they could afford to pay their grocery bill and have people feed their families. So what happened is there was a populist candidate, and that populist candidate was Hitler. The populist candidate was Germany first, screw everybody else, because, and that's a message that sells. And what Charlie goes into with this is, these are the things that will happen. But to Ian's point, and what Charlie says at the end, is Japan went through this, and they're okay. So buy more Costco. So what you have to pay attention to is Hitler could rise in our country. Something could happen. We'd be mindful of it. But we also can't be so scared and afraid of it. We're not opportunists on what is in front of us. And that's what I think these guys do incredibly well. There's another clip in this that I think is great. He says, the Munger family is basically invested in four things. He goes into them and he goes through them. Costco's one of them. Cash is another. Berkshire is another. There's a newspaper. And then the other one is commercial real estate. And he goes, I don't know how to pick 20 things, but I think everybody in my family should be pretty happy that we picked four good ones. So what my takeaway is, control the controllables, do the things you can do and pay attention to, and be opportunistic when that opportunity presents itself so you can protect yourself and your family.
I also think when he's invoking Japan, Latin America, when he's invoking some of these things, the early 80s, late 70s in America, I think what's important for me, what I think about is we are just starting. This is just starting. Japan went through 30 years of nothing. So yeah, they're around, but their economy did nothing for 30 years for printing all of that.
So, Ian, how old are your kids? 11 and 9?
Yeah.
And mine are 3 and 1. So my oldest son was born, and Ian always told me how tiring parenting is. I called Ian on the third day. I'm like, I'm not very tired. And Ian just laughed. He had a 9 and a 7-year-old at the time. He's like, buddy, the tired is coming.
Yeah, it's the old, I think I got lucky. I got a kid that doesn't scream much. And it's like, all right, man. That's what we could be facing, is we have this euphoric afterbirth excitement. And it's like, okay, we all got cash. We're prepped. We're ready to go. Nobody tells me they're nervous about the economy. I'm nervous as fuck, because it's like, we don't know what we're going through. And someone's like, isn't that too much cash to have on hand? We're going to go into this clip later. I'm like, I don't want to almost not drown. I want, if the tides come up, I want to come to my knees. I don't, you know what I mean? So you never know what you're getting into. And what these guys, who are incredibly wise sages, are telling us, they don't know either. And it could be pretty bad. Yeah, I'm in buckle up mode. I mean, I'm in very much where it, people have been saying forever, are we in the seventh inning of this upturn, the eighth inning? I kind of think we're in the first inning of something different. That doesn't mean that we can't make money and you can't be smart and you can't outperform people. Hell, I made a lot of money in 08, 09, 10, 11. I still made money. I still found things to do. But I kind of think this is a new game. I don't know if you feel strongly about it, but I feel like we're entering something different where we're not playing the game of 2010 to 2021. I feel like 22 is like, okay, that game's over and it was a great game. We won. Now we're in a new game and it's different rules. It's different pitchers on the mound. The slate's been wiped clean. Maybe it's even worse. Maybe it's like the first inning and we just gave up 6 or 7 runs real fast. That doesn't necessarily mean we're going to come in the bottom of the inning and go get 5 of our own. Like I think for 10 years, every time there's been a downturn, it's been brief and immediately an upsurge afterward. Even COVID, the scariest 4 months of that, the next quarter, the stocks are off ripping, crypto's ripping, real estate got hot. So I don't know. I feel like you can only have so many of those bounces and keep betting on the future where you just keep printing more money until someone's got to pay the bill at some point.
So what happened in the last economic cycle, September 11th happened in the middle of it. And when September 11th happened, what really happened in English was we were due for and entering into a recession. We had 1 quarter of negative growth. And then what happened was with September 11th, the government came in and printed money. And we ended up having a 6 or 7 year run from that moment forward. And what happened was the financial mess of 2008 through 2012. Like house prices were down from 05 to about 12 before they started to come up again. What happened this time is we were 10 years into an incredible cycle, 11 years into an incredible cycle. And then COVID happened and the government overreacted. So instead of planes flying into a building, we had this mysterious cold that nobody knows how to deal with. And what the government did is they quarantined and printed. So we are in a similar cycle where we probably should have had an adjustment. And hopefully it would have been softer, but it's most likely going to be harder. What I'll leave you with is a soundbite. Parents were in town this weekend. I was talking to my mom and she would ask me about the market. My dad asked the question and I answered it. I'm like, I'm nervous. My mom's like, oh, honey, you'll be fine. You'll get through it. I'm like, I know. I'm not going to jump off a bridge. I'll make it through. But at what cost? Like, how much will I sleep? How much time will I see my kids? What will my company look like on the other side of it? And how fat will I get? Because when I get stressed, I get
how many
fat.
stress pounds will I put on worrying about my investments, my assets, my net worth? Yes.
And that's what happened to me for 4 months during COVID is I just hunkered down. I told my wife, like, you raise the kids. I'm going to make sure we don't go broke. And ultimately it turned out to be very good, but this is the moment we're at, and we won't know where we are at this very moment until time has passed, but there's something here.
It's Frank, this sets up our whole show. So it's worth just staying on for a second. It's animal spirits. It's really easy for a collective group of people to get very excited and to get overly eager in acquiring things, buying things, investing, spending. And it happens even faster when the animal spirits turn and get nervous and people get scared. Right. And I can tell you in everything that I do, I'm worried about the overall sentiment. We've got to raise money right now for keep. And, with 6 months ago, venture capitalists couldn't throw money at tech startups fast enough. Today, there's still money to be spent. What do the terms look like? They're not going to be the same terms they were 6 months ago. Now the expectations have ratcheted up because they're getting burned on so many other things. So it's got this pin action, inflation and stock market dropping is like the kingpin. And it's got this pin action that just ripples through the economy that right now people will say like, I see Joe Biden's tweeting that, look at unemployment, look at all the jobs we've created. And it's like, man, you are, that's like such a lagging indicator. And that's maybe the back row of bowling pins that get hit is employment, because people get nervous. They can't raise money. They can't get capital. That capital was spending money on hiring people, on growth. When that stops, all of a sudden unemployment starts drifting the other way. So it's kind of like, claiming victory on employment right now is a pretty tenuous time to do it.
Well, it's the reason why we're talking about Buffett and Munger. We're not doing a breakdown of Obama, Trump, or Biden and their presidential speeches. So something I trust as an indicator more than I trust our president, sending out masks 4 years after the pandemic starts to everyone in America. Like the homeless people have figured out how to get a mask, but we need you to send us one, which I thought was the most ridiculous thing. But I played golf on Monday with an attorney, and he's corporate counsel for Caterpillar Finance. Caterpillar Finance is the finance company behind Caterpillar. So whenever you see a lot of construction, you see yellow earth movers, they're Caterpillar. And what he said is sales are down, foreclosures are up. It's usually a pretty early indicator of what's coming in the market. And it's already happening. So the reason we talk about this stuff is because if you parse the information together, history leaves clues. These guys have seen more history than us, and we think it affects multiple things. As business owners, Ian and I want to be ahead. We don't need to be like 3 or 4 innings ahead. If we're a move or two ahead, we can outpace the market, and that's enough.
So our Fed has printed record amounts of money for a decade and really super spiked it the last couple of years. That's what's got them nervous. The ramifications of that are just the CPI just came out this morning, Frank, the inflation measure.
I saw it.
The print was 8.3%. That's nuts. That's highest in 30 some years. So when you look at some of that, the ramifications and inflation, Warren Buffett here is going to talk about what inflation does to any investor in the country and really any American.
Inflation, I should say, swindles the bond investor too. It swindles the person who keeps their cash under their mattress. It swindles almost everybody. The problem, if you have a business that doesn't take any capital, and let's just say the dollar depreciates 90% or something, so things cost 10 times as much. If it doesn't take any capital, you can charge 10 times as much, and you've kept your relative position. But most businesses take some capital. If our utility business, just say that the dollar is worth 1/10 some years hence from now, we have to have 10 times the capital investment basically, and we get paid a return on that. But we have forced capital investment to essentially keep them in the same place. And I wrote an article related to that, and I will tell you one famous story, which you will all sympathize with, and that I wrote that story for Fortune, and when I finished it, it was about 7,000 words. And Fortune didn't like publishing 7,000 words, and they had my friend Carol Loomis explain that to me, knowing that I would pay more attention to her than anybody else, but being stubborn and male, I said, every word is precious, and they can either run it or not. So then they sent an editor, a very nice guy, out to Omaha, and this guy explained to me that just wasn't right to use that many words. And I said, well, that's fine, but if you don't do it, I'll write it someplace else or something. Very disgusting behavior on my part. And then I sent it. It was beginning to bother me a little. So I sent it to my friend Meg Greenfield. And Meg was a great, great, great editor at the Washington Post. And we were very, very good friends. Wonderful woman. And Meg, who was tough as nails with most writers, but she was kind of nice. She didn't want to really hurt me too much. So I said, well, Meg, what do you think? And she said, well, Warren, she says, you don't have to tell everything you know in this article. And it made the point. And so I write that article shorter, but I'd say more or less the same thing. No, you're better off if you really could have a totally stable unit of monetary use for the next 100 years, it would be better for business and investors in general.
What I love about Warren, and I think what makes he and Charlie so memorable and so loved by people, is he's smart enough to tell you the scientific reason behind most things, but instead he almost always chooses some story from his life that kind of makes you think about it in a different way. I think storytelling is such an underappreciated skill of famous business folks. And really, a lot of them get to that place because they're good storytellers. They just help people understand. Steve Jobs used to do it all the time when he would get on stage. He would just use stories to kind of relate what he was trying to do to change the world. And I think Buffett's just great at that. But the whole concept of swindling and how inflation swindles everyone, it's just such a silent, it's such a silent thing. You're not always counting how much you pay for your groceries every time, but it just kind of creeps on you over time. And to folks that groceries is a big part of their bill every month, that's brutal. Gas is brutal when it doubles in cost. I can tell you, let's just take Keep and our car alarm company. We based our $199 price on a certain bill of materials, Frankie, and we had reliable estimates, reliable costs. We acquired those components, and we can make our first devices now with those components we bought. But if we had to go out and buy all of it again today, $199 price doesn't work long term. Now, what we've got to figure out is, does that inflation calm down? Does it come back down, the components that we have to buy for that? Because if it's going to come down, we don't need to go react immediately, but we're still a new brand. But do we have to raise the price to $299? And, what we're grappling with is, because to own our device, you have to pay a annual fee. It's a cellular fee for connectivity, all of those things. So for us, the lifetime revenue of a customer is much higher than the revenue of the device, which kind of makes us a little bit like a software as a service company. So we have that renewal, but it's hitting us 100%. We are looking at our bill of materials saying, damn, it is getting really expensive to make this thing. And how many of these can we make at this cost and this price? And how long does this inflated world of input costs last?
So there's the story of the frog who jumps into the boiling water and jumps out. And then there's a story of the frog who's in a cool, tepid pot of water, and the temperature of the water continues to rise, and he doesn't jump out because it boils around him and cooks. When I was preparing for this episode, I watched a different video on inflation. And what it talked about is like, if you could buy 100 meatball subs, which Ian and I both love meatball subs, and we'll probably work our way through a significant number of those 100 meatball subs.
Have you had 100 meatball subs so far this year? It's May 11th right now. Have you had 100 yet?
100 meatballs, because I was at Grandma's house.
100 meatballs, not 100 meatball sandwiches. You're going to need a few more months to get to that level.
But the point of this is, if you have enough money through investments or whatever to buy 100 meatball sandwiches, and then there's inflation and other stuff, if that investment has gone up, but it only buys you 80 meatball subs, you've been negatively impacted by inflation. But if that has gone up to buy you 150 meatball subs at some period in time, well, then you've won over that. But most normal people, and wages, and the reason inflation matters so much is because most people's salaries don't rise with the cost. There's a fascinating thing that I saw an article on. It was sent through the New York Times, but it was it says how much, what percentage of inflation have you factored in? And like, I ended up at like just under 8%, but it asked things like, how many miles do you drive a week? I live 1 mile from home, so I don't drive that much. Did you buy a car? I'd bought one during COVID, so I didn't affect it. But like, I went and changed a bunch of these answers, and I had not been as fiscally prudent, I was driving a bad car that I needed to replace, and I drove more miles, the net effect of me went from like 7.9% to over 15%. So it's little things that can kind of just sneak up on you that make a major, major difference. And if you look at it as meatball subs or family groceries, what you can afford goes down, which causes stress, strain.
It's pernicious too. You don't look at your cable bill every month and see that there was a $2 fee added. You don't look at your cell phone bill. You don't look at all of these input costs you have on a regular basis that are just creeping up all over the place. And maybe you're celebrating that you got a 5% raise. You're poorer this year. That didn't do enough to overcome what's happening. And I think all of those things, you just keep adding, you keep stacking that on. I think the problem that you run into is enough inflation just hurts consumers enough where they stop spending on other things. And they will, it's usually what people usually say is, oh, go buy companies that make the groceries, go buy consumer staples, things that people kind of need that they'll have to. Because the truth is you're gonna, hierarchy of needs, you're going to eat first. And so that might mean you're going to probably buy one less pair of wireless headphones, right? Or whatever it might be, that on the margin, what gets cut off when people get focused on the necessities like gas and core, my rent's way up this year. And you can blame Frank for that. He's really taking them up as high as he can. You look at what you will cut off.
Old can of paint kava.
Kava.
So I'm going to use a weird example here, but the inflation and worrying about inflation, worrying about your groceries is defense. The best defender in the NBA makes about 50% of the best scorer. All of the best scorers in the NBA are your best earners. Giannis, Curry, they make the most money. They play suspect defense. So if you're listening to this and you're like, how do I not let things affect me? They don't affect Ian. He immediately went from groceries to wireless headphones. That's a big jump. He's got a big cushion. But if you're listening to this and you're in this period in your life where you're like, I don't want this shit to affect me. Learn how to earn. Be a scorer.
Which is a great transition into Warren's, and we'll get to that right now.
What would your advice be to people who are investing? What should they change? What should they do?
Yeah, well, inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate.
Very few people invest enough in themselves. Love that quote. And I love that he talks about how most people are not reaching their earnings potential. So the best way to go combat inflation if your costs are going up. And I think this is, he's looking at individuals like you and I, anyone who's listening to this, your career. He's looking at, look at yourself as a P&L, as a profit and loss. Yes, your expenses are going up. You can't do a lot about that. You can try to spend a little less, but what you have to spend on is going up. So what are you doing to increase your revenue? So what are you doing about the top line? Your bottom line is a problem. What are you doing about the top line? How do you go get more business? How do you go get more revenue? How do you go bring in more to compensate for that? And, his advice is invest in yourself, invest in training, invest in your network, figure out ways to be better at what you do so that you can out earn the expenses that are creeping up all around you.
One of the things I hear a lot of instances from people who are employees, owners of businesses do this inherently, but employees are like, I can't afford, or I can't spend money on this. And the question that Warren's asking you to rephrase is, how can you not? Doing the little things that you do early that are on your dime can have massive impacts. And I'll just tell a quick story. When I was 25 years old, 2000, I went and saw Tony Robbins speak. Ryan Holmes paid for it. They sent me there with like a whole group of people. It was like 20 people from our division went. And I thought he was fascinating. And it was a really interesting thing. It was called Results 2000. Like he had Norman Schwarzkopf and like a Washington football player and like different people were there. Trump was the last speaker who like flew in late, the whole thing. But it was really interesting. But 3 or 4 years later, time went by. I read one of his books. I was like, I'm going to go to one of his events. And I went to one of his events, which cost me several $1,000s. And while I was at his event, he sold a package of 3 more events that was $10,000. And I was 28. And it was a ton of money. But he went through this exercise. They did all kinds of stuff. But he went through this exercise where you had to write a letter to yourself. And that letter was, what do you really want? Like, what are you living without? And are you willing to change it? And there was 3 things in there I wanted to do. I wasn't happy in my relationship, which I ultimately got out of. I wasn't happy with my job, and I wanted to own real estate. Those were the 3 things that I wrote about. And he had you post date it, and it showed up in the mail a year later. I still remember that letter. I still have that letter. That cost me $15,000. It's made me millions, because I took the time to invest in myself. And with, like I said, business owners do this inherently. But if you're doing these things, is it reading? Is it finding other people? Like Ian, I can talk to you and tell you stories about the books we've read or the things we've spent money on. And that's what Warren's saying, is become indefensible as a business person. Be smarter. Be someone who is unfireable in a recession. And those are the things that add to earning power and will take you to the next level.
So I love that story. And it reminds me of one, the last time we had a major recession. I don't know if you remember this, but during the housing downturn, when it got at one of its ugliest points, our CEO sent out an email basically saying bonuses are off, and it was kind of late in the year, and I had my plan in the bag. So this email was a bombshell to me and everyone who worked for me, because it was a 6-figure. It was during a time where all of our investments were down, all of our hopes were down. The housing market looked like it was going to be in a disaster for years. And I was counting on that 6-figure bonus on a number of different fronts. And it was incredibly deflating. It was hard not to feel miserable. Do you remember getting that email?
I remember getting the email, and I also remember I ran one of the 2 divisions in the company that actually made its plan 2 years in a row. And I remember being exactly like you, and I was in my low 30s. So like that much money was a significant amount of money then, like a ton of money.
Yeah. And it was brutal. And I remember I talked to our president, and I was very close to him, and I was just dragging my ass. I was feeling bad for myself. My condo price was down 20% and dropping like a rock. I thought it was going to just never stop going. I thought it was going to zero. And we were laying off a lot of people. And I'm just trying to live on a salary in an expensive place with a big mortgage payment. And he kind of said, everything you're complaining about is not in your control. And if you keep feeling bad for yourself and don't focus on what's in your control, it can get worse, Ian. It can get a lot worse. And what he was trying to say is, if you don't perform, you're going to lose your job. And then how bad is it going to be to make that mortgage payment if you're not here? And it woke me up. And, some of the other regionals couldn't wrap their hands around it. Like it was who moved my cheese. They couldn't figure it out. And I just got focused. I thought, okay, what's in my control? I'm going to run the best region in the company. I'm going to perform like crazy with the people that I have. With what I'm asked to do, I'm going to be the best at it. And a year and a half later, we went from, 6 or 7 regions to 4. And one of those regions got enveloped into mine. So now I had twice the size. I had twice the profit center. And in doing so, I was promoted and given stock options at a time where our stock price had dropped in half. So I think our peak at the time had been like $700 or $900 stock price. So I was given options down in the 500 level, and those stock options ended up becoming worth millions of dollars to me because I focused on earning. I focused on being better. I focused on what I could control, which was be a better manager, be better at my job, learn, get better, study every book you can, put in more hours. And because of that, I ended up profiting greatly from a big downturn. And I think that's a lot of what Warren's saying is, yeah, inflation's brutal, but go figure out how to earn more money.
Yeah, it's really wonderful advice. And there are people in this world who are savers. Ian and I are earners. And we might be speaking something to you that makes absolutely no sense. And that's fine. But what we like is a really strong offense. And the team that scores the most points has never lost.
Yep.
Now, they don't always win the championship, but they don't lose the game. So those are things that you have to kind of be mindful of.
So outside of earning, what else can you do and where would you be investing? Warren's got pretty good advice just on what to do in any kind of a recession.
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like, and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and you should pay attention to those bobs up and down.
You literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers.
So much good to unpack on that. So much good.
I love that whole clip, but there's something that I thought was just hysterical to start. Do you know the difference between a bad haircut and a good haircut?
2 weeks.
2 weeks. And that's exactly what Warren's talking about. It's not the short-term game. It's give the thing time. The best deals that I've ever had, I've had for years. And I'm not as old as Warren, but like things I've had 10, 15 years have done very well. Things that he's done for 60, 80 years, they've done incredibly well. But go ahead and set us up here.
No, it's awesome. I love that he says I'm a net buyer of food. He's like, I'm going to buy food the rest of my life, so I get excited when the prices are low. I just love that. And he's like, I'm a net buyer of stocks. So when the stocks are low, I'm more excited than when they're high because I can do something. I can get after it. He says something that I tend to struggle with. So let's say I sell something, I sell some real estate, or let's say I get I get a check from a corporate client. I get $50,000 check and I got this money and it comes to me. I hate having it sit in an account, right? I hate having cash sitting in an account. I feel the need of like, well, okay, what's on sale? What can I go buy? What can I invest in? How do I put it to work in a smart way? And he says something where he says boredom is the enemy of the typical money manager. They just can't stand to not be doing something. And the baseball analogy just really works for me.
It was really great.
It's so good. It's so good. It's like you don't have to swing. You can just sit there and watch him throw strike after strike and not cut at it if you don't feel like it's your pitch. Whereas in baseball, you got to cut because the umpire will call you out for not swinging. There's no penalty for not doing anything unless you feel like it's a really good investment at the time.
So what I think is critical here is this. Most people are not Warren Buffett, and we weren't in a position years ago to be where we are now, to be incredibly patient. Like, most people actually need to earn. And if you need to earn, you feel the need and the desire to swing because you need to earn. What Warren, several of these videos are probably from the 70s onward. He started 20 years before that. So like his need to earn period was gone, and he was in a position of luxury where he only swung when he thought he must. And because he had good, strong fundamentals, he lived below his means. So these are things that take insane discipline that are being forsaken here for speed, but are critical. Like, you need to be in a position where you can be super, super, super prudent and patient. But if you're not in that position, you have to, like the fund managers that he makes fun of, those are people who earn on fees. They have to get in and out or they don't make money. So you have to understand the pressures, and you have to understand where you are. And you don't just arrive here. You get here with a lot of intent and purpose. And to be able to watch things go by and not swing is a position of luxury that is, in his case, was built over decades utilizing patience and long-term hold strategy, but it turned into something incredible.
I love how he says, who wouldn't rather buy at a lower price than a higher price? It's just, that's pragmatic, but it's not the way people work, because the problem is they're seeing that their balance in their account went down. So they're thinking, I lost money.
You didn't.
Really, like, let's take my father-in-law's business, right? Trucking business, not public, small privately owned company. On any given year, someone could value his business at a different dollar amount. Like someone could value it at 5 million one year, 10 million the next. In really heady times, they might offer him 15 million because it's strategic and they want the land and it fits in with their business. And every different buyer has a different opinion of what his business is worth. He has his own opinion. But if every person that came around and said, your company's only worth this or that, that doesn't mean he would sell and panic. He knows what his business is doing. He knows what it's worth long-term, what it can generate for him. And I think it's the same with publicly traded stocks. I think it's the same with real estate. Someone who knows the market knows long-term what kind of income they could generate from a property like that. And you own a lot of real estate that you don't have intentions of selling for a long time. That people pay their rents. And let's say we go through a downturn, some of your properties, if you tried to sell them, would be down 30, 40% from what they were last year if you tried to sell it. But you don't care because people are still paying the rent. You're still collecting cash. And over 20 years, it's going to be worth a hell of a lot more than it was in 21.
The other part of it is, like, you have to take what the market gives you, right? The market gave us low interest rates. That's when I refinanced. Rents would have to go down, like the price might go down 40%, but I don't care as long as the rents don't go down 40%, because in a really bad recession, the taxes might drop a little bit, but my mortgage rate is fixed. So I have a fixed cost and it's a lower interest rate than you can get currently. So I'm protected. He said something else that I think is incredible, and he's not critical all that often. Maybe he's getting old and getting a little curmudgeon, which I like even more. If you're going to sell when things go down, you're not fit enough to own stocks. That was his quote. And it's the truth. Like, I have a friend that's a real estate guy. He bought a bunch of stuff in 2006, 7, and 8. And it took more than 10 years for those to be worth more than he paid for them. But he didn't sell any of them, and he collected rents. And he came on the other side incredibly strong because he had incredible discipline.
I think the last thing that came out of that clip that I really liked, and you started this by talking about it, was if you hold an investment long enough, the risk goes way down. So if I buy a property knowing I need the cash back in 12 months, that is incredibly risky and borderline asinine thing to do. I'm going to go buy that's 2005 flippers. I'm going to buy it and hope the price is higher in 6 months and flip it. That is really risky. If I buy a property and I've looked at what my debt would be, what my payments would be, and what I believe the rent could be, and I plan to hold it for 20 years, I would argue that there's no risk in that at all. It's not, even if you sell it for the same price one day, you'll have made all your money back in rent from what you put into it at some point, if it's hitting the goals that you have, right? Everyone has different goals with their real estate. But I love the way he talks about that is just, and if you think about it that way of, would I want to own this piece of property in 10 years, 20 years? Would I want to own this company? Right. So I always talk about the companies I love, but Frankie, over the last 3 months, as the market's been dropping, I'm buying more Google. I'm buying more Microsoft. I really love Airbnb. I just think in the long term, it's going to do well. I'm buying more Amazon, even though Amazon's probably got more inflationary pressure than all of them. And all I can think about is they generate a ton of free cash. They're just going to keep building this mountain of cash over the next 5 to 10 years. Would I want to own those 3 companies in 5 years, in 10 years? And the answer just keeps being yes. I've owned more NVR. It's a company I believe in. And so I think in a period like this, it's really scary, but you have to think long term. And if you're going to buy, you're just acquiring more of a very solid corporation, and you're more of an owner of a company that can generate profits and cash. Now, are you buying a lot of companies that aren't making profit yet now? No, this is not the market to do that, because who knows if they'll make it. But the ones that are just stacking cash and profits, I'm with Warren. Be a net buyer and chill and hold. And in 10 years, you'll be like, I'm glad I bought.
And the stock market's a lead indicator. My industry is a lag indicator, right? Like we talked about, employment numbers drop after a company starts feeling pressure.
That's right.
Real estate hasn't started to have those moments, but I'm ready when they do. And I have to be very fiscally prudent to get to that point. But that's what I'm waiting for, is that pullback. Like, when will there be a pullback? When will something come about? I've got my eyes on stuff. I know what those numbers are. And maybe I don't time it exactly perfectly. I don't grab the falling knife perfect. But if I get it at a discount and I ride it into the future for 1, 2, 3, 5 decades, it doesn't matter if you got it exactly right. It matters. There's other factors there. So you have to understand what your asset class is and realize a pullback is a wonderful opportunity.
Hope that little episode gives you some perspective and helps you relax a little bit with your investments, with everything you've got going on in your career and facing this market, which maybe the start of something big, might be a continuation of something else we were feeling, but we'll know more in about 5 years. And we had a great time digging into some things that the Oracle had to say about this. If you liked it, share it with someone who also is an investor like you. And if you have not subscribed, please click that button. And if you have not given us a 5-star review on Apple and you've been a longtime listener, I'm begging you, please give us a 5-star review and leave some comments about what you think about the show.